All right, everyone, thank you for bearing with me. Once again, welcome to our Pacific Northwest State of the Apartment Market Update for fall 2020. We have a lot to cover today. It's been a very exciting year all over the nation, especially in the Pacific Northwest. There's a lot of data that we have. Really appreciate everyone joining. We're going to dive right in. Starting right off with our agenda. Rent, vacancy, concessions, and collections. We'll move into development pipeline, future of demand, sales trends. Then we'll get into employment and finally forecast. So starting off with rent, vacancy, concessions, and collection loss, taking a look at rents and vacancy across the region, we're looking at the left-hand column at rents and vacancy as of September 2020 as comparative end of year 2019. And the phenomenon that we're seeing that shouldn't be too surprising to anyone is we're actually seeing rental rate declines as well as vacancy increasing. And this is just something we have not seen in this marketplace probably since 2011. Now, predominantly where we're seeing this is in the urban market. So across Urban King, North King, and East King, we're actually seeing rental rate growth stall while vacancy increase. We'll get into these markets with a little bit more detail, but differently, what we're seeing in South King, Snohomish, and Pierce is actual rental rates increasing, not by a lot, nominally, but vacancy staying low or actually dropping lower than it was before when we recorded these numbers in 2019. The one outlier market is Kitsap, and we're actually seeing some rental rate growth, but also increase in vacancy rate. And we'll discuss the reasons for that momentarily. Now, taking a look at where we're seeing rental rate actual increases across the market, predominantly what we're seeing is them in outlying suburban markets where rental rates had not surged nearly as much as they had in the urban markets. Now, the rental rate growth we're seeing is fairly nominal, about 2% year over year, and that's not a huge amount. But contrarily, when we look at some of these urban markets, we're seeing steep declines, and we're seeing actual double-digit declines in downtown markets. Now, when we look across the nation and we look to markets such as San Francisco and New York, we're seeing rental rate declines in downtown San Francisco as great as 15 to 20%. Now, maybe that makes us the best of a bad lot, but it's been a reversal of what we've seen in otherwise growth in urban markets. And it may be alarming, and I think at first it really is, but once we dive into the data, we're going to see what's developing in some of those trends and why it's not to be too concerning in the long term, although in the near term, these are some pretty big rental rate declines. Now, looking in the urban neighborhoods, this data takes us back 20 years to 2000, and the bars represent actual rental rates and the line is showing vacancy rates. Now, the green line here looks from 2009 to 2019, and we've had 10 years of steady rent growth, absolute phenomenal rent growth across our urbanized markets. Now, not to anyone's surprise, what we've actually seen is a dip in rental rates year to date for 2020. No great surprise there. Now, if we look at what's happened with vacancy during this time, since the downturn in 2008, 2009, we've seen a drop off in vacancy, meaning increased occupancy, then we've seen some choppiness. Now, overall vacancy rates have remained low, but a lot of this choppiness is due to the influx of a tremendous amount of new supply. Now, we've had a lot of job growth to balance that out, but that's the challenge we're having in 2020 is that job growth has stalled. Now, to put some numbers to this, the inventory in these urbanized markets as of 2010 was just shy of 70,000 units. Now, if we look at how many units we've added in the last 10 years from 2010 to 2020, the first quarter, we've added 50,000 units. That's a huge surge in the amount of units in that market. Now, it's phenomenal when you look at the amount of rental rate growth we've established during this addition of inventory. Yet where we are in the market right now, once we've stalled out on job growth and we keep adding these units, it explains why we're having some decrease in rental rate growth as well as higher vacancy. Now, looking ahead, what we see under construction is about 16,000 units. And in these urban markets, we've been adding about 6,000 to 8,000 units per year. So what we have is a little over 2 years of supply of actual construction that will deliver in the next 2 to 2.5 years. And that is going to create some localized challenges in some of these markets. And we'll discuss in a moment where we see those challenges. But overall, the urban markets perform fantastically. What we're experiencing right now is a supply and demand imbalance. And we'll talk a bit more about where we see this imbalance lifting and seeing greater demand than supply. Now, the overall trends here is rental rate growth is stalled. No question about that. Vacancy is we're starting to see higher vacancy rates, and that's really come up in the last 60 to 90 days. Now, really what we define this as is going from offense to defense. We're maintaining occupancy versus optimizing rental rates. And the optimization of rental rates has really been the playbook for the last 5 to 6 years. Now we're seeing owners and operators really playing defense and trying to maintain occupancy while establishing a baseline of rental rates, and that's a challenge in this market. And next is taking a look at where we're seeing those challenges the greatest. Now, without a doubt, the most attention, even nationally, during COVID was on Capitol Hill for the last 3 weeks of June and the first week of July with the CHOP Chaz zone. And that really has not bled off. And what's happened is Capitol Hill's just not as fun a place to be right now. And as a result, we're having trouble creating additional demand in Capitol Hill. And as a result of that, we're seeing a decline in rental rates and decline in vacancy. I guarantee you this is a blip on the radar. Capitol Hill is one of my favorite markets, and we're going to see it come back and roar back. What's interesting about Capitol Hill is it's the closest market to the east side. So those of you racing to the east side, for those renters that want to stay urban, Capitol Hill is that market. But right now it's suffering some near-term challenges. West Seattle, without question, got the 1-2 punch from COVID and the closure of the West Seattle Bridge. That's fairly binary as well. We're going to see that bridge get repaired or a new bridge come up in the next several years, but owners are challenged right now in West Seattle of maintaining those rates. And finally, South Lake Union. And the challenge with South Lake Union is it's somewhat of a corporate campus. And when the corporations go away, campus goes away. So it's not that fun of a place to spend your time on the weekends. And it's certainly not a fun time to it's not a fun place to spend your time during the week when no one else is there. So when employers start having their employees come back, South Lake Union will come back again. But these are the urbanized markets with the most challenges right now. And as we're talking to owners, the owners are feeling the greatest challenges in these markets. Next, as you can imagine, each market is behaving differently. So all of these markets across are going to change a little bit differently over time. And what we're seeing right now is certain markets are having more challenges. Other markets, we're seeing tremendous stability. Green Lake, tremendous stability. People have a lot to do around Green Lake. Queen Anne is doing fantastic. Ballard's doing fantastic. Now, switching over to more of the suburban markets, next we're looking at North King. And North King, what we're seeing there is a lot of rental rate growth, basically, again, from 2009 moving forward. In year to date, we haven't seen a drop off in rental rates. Now, there's been a slowdown in rental rate growth, but these markets, we've seen people move out of the core into North King, and these markets have remained stable. From an occupancy standpoint, occupancy stayed fairly low, and then it started to pick up. Now, or pardon me, vacancy picked up as did occupancy slid, pardon me. And one of the reasons is we've had new supply added to that market. The other reason is we've seen a lot of owners in North King raise rental rates. And as they raised rental rates, not every renter was willing to pay those rates to live outside of the core. So we've seen it bounce around a little bit. In the last few years, it's been fairly stable. Now, taking a look at supply versus demand dynamics, North King, there was about 15,000 units when we started this market cycle, and we've added about 5,400 units. So we've added about 15% supply, not nearly as much as in the urban markets, and that's why we haven't seen vacancy rates spike nearly as much as we've seen in the urban core. Now, looking at what's under construction, we've got a little under 10% under construction. So that's very manageable, but we're going to see a little bit of bounciness in North King as we find stability in that market. Moving over to East King has had fantastic rental rate growth across the market. Now, in the last year or so, it started to taper off. And again, two reasons. One is owners pushing rental rates. The other reason is we've added a lot of new supply. So vacancy as well, we've seen really strong occupancy. Vacancy rates have stayed low, but we've seen it creep up. And I think a really good explanation for this is the addition of inventory. The inventory in these markets as of 2010 was 22,000 units. In the last decade, we added 50% to that market. So it's no great surprise. And we started adding those in 2014, 15, and 16. And that's when we've seen occupancy increase, or pardon me, vacancy increase. Now, what's great about that is we've also seen rental rates increase. So when we see rental rates increase along with vacancy, what we're seeing is basically a market finding equilibrium, but continuing to grow. Now, we do have quite a few units coming in, about 15% addition supply. And I think one of the challenges in East King is where the concentration of that supply is. And you can go to our website, dylansimon.com, and look at our research there. And we have a map of where all of these new developments are occurring. And you can see where there's some concentrations. For example, we have quite a bit of concentration in Totem Lake. There's a concentration in Redmond. And these markets are going to have a little bit more choppiness to absorb these new units. Now, in the COVID era, where more people are moving suburban, I think there's going to be less choppiness, and that's timed well to add those units. Now, moving to South King, if you've been on these presentations before, you've heard me say is a sweetheart story. That is a terrifically inclining line of rental rate growth, just as we've seen vacancy plunge down. And these are the curves I like to see on any sort of graph. And South King has been the strongest rental rate growth market across the entire region, even through COVID, and it's maintained the lowest vacancy rate during this time because we haven't added a lot of supply, and there still is a lot of affordability in these markets. Now, we've seen vacancy tick up a little bit, and part of this is finding that equilibrium with rental rates, and we've continued to see owners raise rental rates in South King because there's such a gap between rental rates in the urban core and what we're seeing in these otherwise suburban markets that are close to job centers. Now, looking at inventory in South King, about 51,000 units. Now, we've added about 8% of supply, 8% supplied inventory, which is not a huge amount, especially looking at these other markets. And as a result, you can see why we've had such terrific rental rate growth and low vacancy is because we really have not been competing with new construction. And looking at what's coming in, we've got about 2,000 units under construction right now in South King. Most of them are concentrated in certain markets, but these have been strong markets like Kent that have absorbed these new units very well. Kent itself is urbanizing. We're seeing some new development in Renton, and we're not really that concerned about it because we've seen really strong demand in South King. Now, turning outside of King County to Snohomish County, again, we've seen a nice curve of increased rental rates. Now, it was fairly flat from 2009 to 2012. So it took Snohomish County a little bit longer to pick up, and we've talked about this before, but the steady growth from 2015 forward has been nothing short of phenomenal. And we've even seen rental rate growth year to date. Now, looking at vacancy was a touch higher during the downturn, and it's bounced around, with each year. And part of that is the market trying to find its equilibrium. Owners have raised rental rates. People have been pushed out north of Snohomish County and outside of Snohomish looking for better affordability. And then rental rates have subsided a little bit. So that's the choppiness that we've seen. But overall, it's been a strong market. I'd say the outlier going on right now in Snohomish County is North Snohomish and in Everett. And the question remains, what's going to happen with Boeing? And there's a lot of questions about that. We've seen a lot of growth in downtown Everett. We're a long-term believer in the Everett market, and we see a lot of stability in that market. So like all things, at first they seem a little bit scary, and our region has been less reliant on Boeing over the years. So we're definitely going to shed some jobs there, but we see a lot of employers backfilling those jobs as well. If you look at new construction, we've had an inventory of about 35,000 units. We've had about 15% inventory growth over a decade. So one of the slightest inventory growth overall in the region, and we've got, again, about 2,000 units under construction. So we don't really see too much headwinds as far as new construction coming into this market. And overall, we're very positive about what we're seeing in Snohomish County. And I think we're going to find out the suburban markets continue to perform well. Now, moving down to Pierce County, And Pierce County's has a little bit different phenomenon. And part of that is it's taken a while for rental rates to grow there. And unlike Snohomish County, where we started to see them coming in 2012 and 13, it really wasn't until about 2015 that we saw rental rates pick up in Pierce County as renters were searching for affordability and moved south. Now, since that time, we've seen some really strong growth, as is depicted here, and that growth continues into 2020. And even through summer 2020, we're seeing strong rent growth in Pierce County, and we're hearing from our clients down there that they're still continually pushing rental rates. And what's really fascinating is you look at the sharp decline in vacancy, and although there's been some choppiness, you see that curve continuing to go further downward. And it's the only market we're measuring where we're actually seeing vacancy rates plummet down, as well as adding rental rate growth to your rent roll. So it's probably the strongest performing market we've seen right now through the summer is in Pierce County. Now you look at new development, we've had an inventory of about 52,000 units in Pierce County, and we've added again about 15% over the last decade. And we look at what's coming in, a very paltry amount. So we're not seeing a lot of new development in Pierce County. Where we are seeing development is in downtown Tacoma, and we feel strongly about an urbanizing Tacoma. And I think that's going to be a terrific investment market this next decade to come. Really, the headwinds in Pierce County is just how much you can raise rental rates before renters find Pierce County unaffordable and they move down to Thurston. But for right now, Pierce County is really turning out to be a sweetheart market. Moving to Kitsap, Kitsap County's had an even further delay in picking up rental rates, much like Pierce County, but once it picked up rental rates, they've been really strong. Now, a little bit different than Snohomish and Pierce is we've kind of tapered off with rental rate growth in Kitsap County, and there's two reasons I'll get to in a moment. Now, vacancy has taken a sharp decline, so occupancy rates have increased, and we've now seen vacancies ticking up right at the same time that we're seeing rents plateau. And there's two main reasons for this. Now, one is new development. We saw about 10% increase. Now, it's not a big market, so it's very sensitive to new development. The greater reason is we've seen a lot of transactions in Kitsap, at least relative to Kitsap's history, and most of these transactions are acquisition value add. And as these owners decommission units, perform renovations, and put them back online, a lot of them have been coming back online at the same time. And as a result, it's taken a little bit longer to absorb these units, and we haven't seen the rental rate growth continue to push. Overall, we're very bullish on Kitsap County. I wouldn't even call it headwinds. I think it's just a pause in the market as we're absorbing new units under construction, absorbing post-value add buildings. I think we're going to continue to see rents in Kitsap County surge even through this COVID era and in whatever sort of recessionary period we're working through. And we'll get to the length of that, at least some prognostications on that in a moment. So next thing we'll talk about concessions. Now, concession rates are not something we've really talked about much. This curve you see right now and these bars represent a percentage of buildings offering concessions. Now, usually this curve you'd see opposite. The concessions are in the fall and winter time, and they trail off in the summer. Now, this is absolutely the phenomenon of COVID and what's been going on in our market, and they've been increasing. Now, they've tapered off in August. We don't yet have September data. My expectation for what I'm hearing is September is pretty close to August in the numbers we're seeing, with about 32% of the buildings in the market offering concessions. Now, the amount of concessions is what's really important, and it's about 4%, which equates to about 2 weeks of free rent, and that's really just to create some momentum in the market. I think the big difference is we just have not seen concessions in the market unless it's been new construction and in the fall and the winter. Now, taking a look at where the concessions are hitting the most, and it's mostly units built in the last several years because they're suffering the most competition. And now we're seeing these numbers tick up to upwards of 60 to 70% of buildings offering concessions in the marketplace. These numbers are bouncing around. I expect August and September are going to be a bit higher than July. We had fantastic leasing in July, but I think we're going to see upwards of 70% of buildings offering concessions. The other aspect is the amount of concession is about double. We're averaging about 4 weeks of concessions. Now, phenomenon we're seeing in the market right now is we actually have had some buildings out there offering free rent until 2021. I've seen up to 12 weeks of concessions. So owners are really hunting around trying to figure out the strategy to keep buildings full. Most of these are in these urbanized markets that are having the most competition with each other in new construction. And this is a temporary period we're going to get through, but right now, concessions are a tool that we're using in order to combat the amount of competition in the marketplace. Next, taking a look at collection loss. Now, collection loss isn't something we've spent a lot of time this market cycle looking at. And generally, we've seen buildings have 0 to maybe 1 or 2% collection loss. Now, what we're seeing right now is a little bit greater collection loss, but not nearly as much as people were concerned about. Now, we're switching to national data, and this is some of the best data that we have. And this is a NMHC, National Multifamily Housing Council data tracker at nmhc.org. You can find this yourself. And this is comparing 2019, the top of the graph, to 2020. Now, September of 2019, on average, this is across 11 million units, they collected about 95.5% of rent. Now, switching to September of 2020, they collect about 94.6% of rent. So that's not much different. What you see with these color gradations is it's taking longer to collect that rent. So the orange is the 6th of the month and the black is the end of the month. So it's taking to the end of the month to collect all this rent. We only have data through the 13th of October, and we're in the mid to high 80s, which is comparable to previous months during COVID. We don't have data for today, the 20th out, but my expectation is we're going to see collections top around 94.5% to 95%. That's what we've been seeing so far. The question is, where are we seeing these collection losses? Mostly it's in the suburbs where there's less ability to pay and there's less savings accounts. So it's a little bit contrarian. Where in the urban core, we're seeing greater concessions and a rental rate decline. In the suburbs, we're seeing greater collection loss. Now, looking at rent forecasting, what we're looking at here is data from CoStar. And to the left of the graph, this is what is truth. This is what's occurred. The center line of the graph is the forecast. So these are asking rents. Now, we've seen steady increases in asking rents through March of 2020, and we were topping out about $17.22 was average rent in this market. Now, what we've seen is a drop off since March, and the forecast, as we cross the forecast line, what we're looking at is the anticipation of asking rents dropping. And what we're going to start to see is owners, instead of offering more and more concessions, they're going to lower their asking rental rates. And that's just what we're going to see through the fall of this year. It's nothing to be nervous about. We're just resetting the market. Now, what they're expecting is by the end of 2021, we'll be picking back up and we'll have a very strong recovery in asking rents. Now, we'll get back on trend line by 2023 of where we were before with rental rate growth. And it's going to happen fairly abruptly. It's predicting somewhat of a V-shaped recovery. There'll be some fits and starts as we get through spring and fall, but really we're looking at the bottom of this about midpoint of 2021, which will be in 2021 in just a couple of months. Now, next, we're looking at predictions for market rent growth, the percent of rent growth that we're adding to rent each year. And what's terrific is how we did this last decade. Basically, from 2012 to 2019, we were getting about 3 to 7% annualized rent growth year over year. And when you compound that, that's the 40 to 60% rent growth we've seen in this market across the last decade. It's been fantastic. Now, again, taking a look at where we are, we've dropped to the zero line. So we're now seeing some declines in rental rate growth. And the forecast is we're going to continue to see some declines through the end of this year into the beginning of 2021. And the prediction is we're going to have a rebound. Now, I don't think this rebound is going to be equal. And from the data that we looked at in each of these submarkets of how much new supply is coming online, how much inventory there is, we're going to have an unequal recovery in how much rent growth. So this V may be shallower or steeper in various markets, but the predictions are we're going to pick back up and we're going to get to positive rent growth. Maybe it's 2021, maybe it's 2022, but by the midpoint of 2022, we're going to be racing back up to our previous peaks and getting back into that 3 to 8% rent growth. And then we don't have enough data to see what's going to happen 5 or 6 years out. But overall, it looks as though we're going to be, it's always darkest before the dawn, which is pretty much where we are right now, and it will pick back up from there. Next, looking at occupancy trends, and what we're looking at here is a graph of what vacancy rates look like. Now we're going to study the left hand of the graph momentarily, and the reason I added this is because market cycles are not smooth. Now, coming out of 2009 into 2011, we were having a great recovery, but you can see here, vacancy spiked back up. And the reason I want to point this out is don't get nervous as we get into the midpoint of next year and go quarter by quarter if we see some spikes in vacancy. It's not always smooth, especially with seasonality. Now, what we saw through the last recession coming out of it is we went back down to 4.5% vacancy across the market, and we went through and had some choppiness. Now, keep in mind, we added, and we'll get to this in a moment, about 85,000 units to the region during this time. So you'd expect there to be some choppiness as we're adding units to the market. Now, the forecast is what we've seen so far is a bit of a spike in vacancy. It's going to continue, and then we're going to get through this. And from this point on, it's going to drop back down. And that's generally what we see with market cycles. Now, the key takeaways for rent and vacancy goes without question, expect volatility. Each submarket will behave differently. We've talked a lot about that. So it's really important to look on a granular basis and really understand each submarket and not apply a broad brush to the region. Next is collections. And I noted here, collection loss is the new vacancy. And this is showing up in two areas of the market. One is with lenders and two is with buyers. When buyers or lenders see tenants not paying rent, they essentially view those units as vacant units. So collection loss is having an impact on the market, and it's very important to collect rents, especially if you're looking for a refi or you're looking to sell your building. Now, it's always important to collect rents, but it's finding a healthy balance of assisting your tenants, keeping your buildings full, and also getting enough collections to pay your mortgage and keep your expenses low as possible and making sure you're cash flow positive. Next is actual concessions. Now, we talked about this a bit. They're creeping into the market. There's going to be this interplay between concessions and actually lowering rental rates. So keep an eye on this. Also keep a watchful eye on new development, as they're going to need to create some velocity to their leasing, and their tool is going to be concessions. Finally is timing and volatility. I expect we're going to have a rough winter ahead, and it's going to take 12 to 24 months for the overall market to reach stability. Now, as we talked about, some of these submarkets are stable already. Now, others aren't as stable, and it's going to take a little bit longer. But overall, as we're getting through 2021 into 2022, we're going to start to see some grass shoots, and I'm very confident by 2023, we're going to see a very healthy growing market. Now, switching over to new development, taking a look at the data. Now, broad brush across the region, we measure it across all 4 counties, Snohomish, King, Pierce, and Kitsap. There's about 336,000 units in the region. Now, this cycle alone, we've added 85,000 units, which is a huge number of units to add to the region during a decade period. Interestingly, we have 102,000 units in development. And we'll talk about what in development means in a moment, but that is an astounding number of units that we have teed up right now. Now, a little bit back down to earth, what's actually under construction, and what's under construction is what we can predict is what's going to deliver, and that's 27,000 units. It's not a peak. Last year, we had 33,000 units under construction as about the midpoint of 2019. So that number subsided about 20%. We'll talk about some of those reasons in a moment. So we're actually seeing a slowing of the development pipeline. Now, taking a look at this over this market cycle, this measures 2010 through 2020 and into the future. And what we're looking at here, we'll start in 2014 because this is when the deliveries really picked up. Each one of these years, you can look at the bottom, we added between 9,000 and 11,000 units for 6 continuous years. A huge amount of supply came on in the last couple of years, which really is a testament to how strong this market has been. And overall, about 85,000 units were delivered in the last 10 years, which marks about 34% inventory growth over the inventory in the market in 2010. Now, comparing that number to what we have under construction And what we have in review right now, just a small portion are approved because most of them go from approved into construction. That's about 102,000 units. And that marks 30% of the current total inventory as of 2020. Now, what's important with that is in 2010, we had about 15, 20,000 units teed up for the next market cycle. We have 100,000 units teed up for the next market cycle. So that's going to have a big impact on how these markets are going to grow and how supply and demand will be in balance the next several years. And it's going to be important to pay attention to which markets have the biggest development pipeline. Now, turn to that right now, taking a look at Urban King, about 67,000 units are under some form of development in the urban pipeline. Now, taking a look at our urban markets here, so basically from West Seattle to the west to about Ballard to the north, 405 to the east and bottom of the lake, about 67,000 units in some form of development, whether it's an application for a permit to under construction. Now, what I've highlighted is a couple of boxes here. Now, in these boxes in red is the number of units in development, and what's in gray is the percentage of inventory in that market. And what I've highlighted is each one of these markets that have a greater than 50% of inventory under development. And these are the markets we've got to keep a close eye on because we're adding a lot of units. Now, it's going to be important to look at how many of these are under construction versus just proposed. And that's what our data provides. If you go to our research, you'll be able to dice up each one of these submarkets. But it's important to look at the amount of development compared to inventory to see how new developments can impact rent and vacancy trends. Now, taking a look at the overall market cycle, and we'll see South Lake Union added about 188% to inventory this last cycle. Now it's tapering off. So I feel pretty comfortable these next 15% of units we're adding are going to be absorbed well. Now look at downtown, we added about 100,000 units, but we still have 25% more inventory growth to go. Capitol Hill, again, a lot of inventory added. And you'll notice, finally, we've got West Seattle, quite a bit more inventory added. We've got several of these markets that are having some challenges with closure of the West Seattle Bridge and COVID. So we've got to keep an eye out for these markets in the near term. They are the strongest markets in the region, and so they will be fine. It's just near term, they're going to have some challenges that have to be overcome. Now, next, looking at Suburban King, similarly, we've got outsized growth in a couple of markets. You look at Bothell and Kenmore added quite a bit of inventory. Issaquah added quite a bit of inventory. North Seattle and Redmond, but none of these crested over 100% of inventory growth like we saw in some of these other urbanized markets. Now that we have a trend of more people moving out to the suburbs, I expect these units are going to be absorbed fairly well as they're added to the marketplace. But it's important as you're analyzing this market, and we've never analyzed the market more carefully than we've had to do in 2020, that we need to do it on a sub-market basis and be very cautious not to paint the market again with a broad brush, because each sub-market is going to behave differently, especially by vintage of asset, as the newer vintages tend to compete with each other and the older tend not to compete with the newer ones. So it's really important to look at where the development pipeline fits in. Now, some forecasts for supply versus demand. This is more data from CoStar. There's a lot going on in this graph, so let me parse it off. Blue lines are change in supply, new development. Yellow is change in demand. And as you can see, we've had a pretty solid outpace of demand over supply. Now, what's predicted right now is we're going to see a spike in the blue. This is coming into next year, which means supply is going to outstrip demand. And then we're going to hit this point of equilibrium, which is around 2022. And all of a sudden, we're going to see growth in demand to outstrip supply. So taking a look at the fact that in just over 60 days, we're in 2021, 2022 is right around the corner. So I know there's been a lot of concern with the apartment market, but when you look at the data and you look at the amount of overall demand in the market, there's really not that much to be worried about. It's more focusing on where there will be near-term challenges. Now, this is the baseline. In order to scare us, we're looking at a severe downside. And the difference in these two is in the baseline, we're looking at a recovery of job growth by the middle of 2022. This severe downside is not having a recovery of job growth till 2027. Now, interestingly, we see a huge amount of supply outpacing demand, but again, by middle of 2022, even in the severe downside, we're already starting to see the spike in vacancy fall, which is the green line is beginning to fall after it crested in 2022. And we're seeing a pretty quick outstrip of demand and supply. So although this is a severe downside, we're already seeing the potential for market growth as soon as 2023 and 2024. It's just a little more tapered. Otherwise, this point of equilibrium would be much further along in the graph. So key developments or key takeaways for the development pipeline: significant new deliveries. We need to absorb about 10,000 units for the next 3 years. Now, the previous 6 years, we absorbed 9 to 11,000 units while adding rent growth. So we've done it before. We're just going to be doing it in the near term with less job growth. That's going to take some time. Next is concentrations will pose some challenges. So we're already seeing some declining rents and escalating concessions in the urban markets. So we're really going to have to balance these out and look for new development and understand those dynamics and just accept the fact it's going to be a tougher road to hoe around concentrations of new supply. However, the flip side is we're having a slowing development pipeline. And this is the point I wanted to revisit when I talked about this 20% decline in new deliveries. One is we're having slowing rent growth. So developers are not able to justify breaking ground on new developments until it makes a little bit more sense. Next, expensive construction is slowing us down as well, and we're facing challenging in financing. So it's overall slowing the development pipeline. It's separating the proverbial wheat from the chaff, which is a good thing in any healthy market. And we're going to see a lot of development sites change hands to developers that are a little bit more equipped to weather this storm. And the prescient ones out there right now are looking how to deliver buildings into 2022 and 2023 when the market is expected to pick back up. So although slowing pipeline might sound negative, it's really perfectly timed to what we're experiencing in the market right now. Next is a trend from urban to suburban. We've heard a lot about this. We think everyone's going to move to the suburbs. So the timing's really perfect that we're seeing more suburban development. When we were doing our research in 2015, about 85% of new development was in our core urban markets. That is shifted to about 67, what we saw 67%, 67,000 out of 100,000 units are in the core urban markets, meaning about 33% is shifted out to the outlying areas, the more suburban markets. Some are urban markets and otherwise suburban markets like Kent, Bothell, Woodinville, Renton. So we're seeing this shift and it's well timed, but we were seeing this pre-COVID. I think it's being amplified by COVID, but like all things that are amplified, they're going to settle down a bit as we get through this market cycle. So want to take a little bit of time just talking about the future of demand because we are entering a new market cycle and we're going to see some shifts. And this is trailing off some things that we've already seen before this market cycle happened. This shift happened in March. And this is a shift from focus from Seattle to East Side markets. Now, taking a look at office space, because that's really the predictor of demand in apartments is, how many office workers are you going to have and how much demand are they going to have for apartments? Looking at total market size, Seattle's got just under 90 million square feet. The East Side's got just under 45 million square feet. So about half the size of the market. End of year vacancy 2019, both were sub 5%. Taking a look at net absorption, they both absorbed a good amount relative to inventory. However, Seattle just had a lot more construction, and so they have absorbed a lot more square footage. Now, looking at what's under construction, they're both seeing about 12, 13% new construction coming into the market. Pardon me, more like 6% coming into the market, and they're pretty equal. It's the next stat that's really telling, pardon me there, is actual space that is pre-leased of what's under construction. And that's where the East Side is really starting to shine. Seattle's under construction space is about 34% pre-leased, whereas the East Side is 82% pre-leased. So that is a terrific stat for the East Side, very inspiring. Having a little problem with my slide advance here, bear with me. Now, switching to East Side office development, we're looking at a total inventory of about 45 million square feet. Under construction and proposed, we've got a pipeline of about 14.5 million square feet. Predominantly about 10 million of that is in downtown Bellevue. Now, as a percent of inventory, it's about 16% there, and in East Bellevue, it's about 10%. These other markets, not as much. And we'll get in a moment why we're looking at some of these other markets. And finally, vacancy rates are very low. I think the best statistic here and the most telling is what average rental rates are. And rental rates that we're seeing on the east side have now finally topped what we were seeing in Seattle. Asking rents in Seattle peaked out at about the mid 40s, and now we're seeing asking rents. And this data is pre-COVID, so we're seeing some shifts. We're actually seeing some acceleration in downtown Bellevue, but it is topping what we're seeing in Seattle by almost as much as 10%. And part of that is just a shift in that market and a lot of demand to go to that market. Again, really good news on the east side is 82% pre-leased of what's under construction. Now, turning to the footprint, I wanted to show this graphic because it's really impressive. Top left-hand corner, Amazon speaking for about 6 million square feet in downtown Bellevue. We have some data to show that could be getting as high as 7 million square feet, but that's a staggering amount of square footage they either are occupying or planning to occupy in the next several years. The other thing that's really interesting is looking at total office space, but also looking at the number of apartments coming in and even retail. We've got nearly 600,000 square foot of retail coming in to the east side in downtown Bellevue, which is going to make it a very livable, fantastic market. And it's going to start creating more urbanism and making it a direct competitor to Seattle. And I think it serves well that a healthy Bellevue makes for a healthy Seattle. And I think this is the first time where those markets are starting to get more in balance with each other. Now, where are people going to be living? And so what I want to look at in this, when we're talking about new demand drivers, is some newer markets we haven't spent as much time on. Now, here we're looking at Kirkland, Juanita, and Totem Lake. We've got an office pipeline of about 600,000 square feet, 200 square feet per person, and a multiplier of every person working in one of those jobs has a support staff of what we call helping them, Uber drivers, people cutting their hair, dog walkers, medical staff is generally 4 to 1. So we're looking at about 11,000 jobs on the multiplier for a total of about 15,000 jobs. You look at one job, 4 jobs is one apartment unit, and the demand for apartments is pretty strong in these markets. You look at the supply and it's in balance. So some people have been a little bit concerned about the amount of supply delivering to Totem Lake. When you look at these stats, it's very much in balance. Now, looking at lifestyle dynamics, especially in this post-COVID era, the average apartment rent's about $2,000. Average mortgage is almost double. And you look at what we're seeing with school systems. We skipped that part of the slide, so it looks like it's not going to let me go there. Most of the schools are ranked very high. So as we're seeing millennials move out of the urban markets and find better footing in some of these otherwise suburban markets, my expectation is some of them will stay because they're thinking about having kids and schools are becoming more important. Now, moving to another grouping of markets we haven't spent as much time on, Kenmore, Bothell, and Woodinville. Again, these are markets that are starting to grow. We're adding office space. So we see about 700,000 square feet of office space coming in. Again, jobs, multiplier, potential jobs, apartment demand. It looks like these markets are going to need some more, some more apartments for the demand that's coming into these markets. So even in an era post-COVID where we see people moving to the suburbs and we expect some of them to come back, I posit that these markets, what I call urban suburban markets, their growth is going to be accelerated by what happened with COVID. I believe in the urban markets, but I think we're going to see more growth in these other markets. And again, militating towards apartments, rent is still cheaper than mortgages. So a couple of takeaways on the future of demand. All eyes are on the east side, but job growth remains strong all across the region. But office developers are staying ahead of it, especially on the east side, and we're seeing a lot of pre-leasing. Next, east side hub and spoke. We're going to see nodes of office with apartment development expanding. These are some of these markets we just discussed, that are going to be a little bit more hub and spoke. Those of you who know the Bay Area, look at how the East Bay has grown, and you've got markets like Walnut Creek, Livermore, Pleasanton that have all expanded from the growth that's happened in Oakland and in the east side of the Bay Area. And we're going to see that same phenomenon occurring here in Seattle and Bellevue. Next is it's a balancing. It's not a total shift. We've seen everyone move to the starboard side of the boat, being Bellevue, and come over there. Bet your bottom dollar we're going to see just as much vibrancy in Seattle as the market swings back. The pendulum always swings, and I really don't think that those that are counting Seattle out are going to stay out of Seattle that long. It just feels very comfortable to go to the east side, just like it's very comfortable for many of these employers to say their employees don't need to come back to work. Well, bet your bottom dollar in about a year, they're going to need those employees to come back to work, and we're going to need people here in downtown Seattle. Finally, taking a look at sales trends. Now, historically, we go back about 8 years in sales trends. We had a market peak, surprisingly, in 2016. So in 2016, we had a peak, 344 buildings were sold in the region, about $5.5 billion in investment volume. And as you see in 2017 and 18, sales volume dropped off quite a bit, and we expected that to continue. What we didn't expect was the change in the excise tax. And accordingly, 2019 was a banner year of sales, both in transaction volume and in dollars spent. We hit almost $7.4 billion spent, the biggest year we've ever had in the region. But you look at cap rates were actually their lowest in 2018 throughout the region. We've actually seen some expansion in 19. And if you look at the first half of 18, it's been pretty paltry. We've had about an 80% drop off, about 75 to 80% drop off in transaction volume for number of sales. We've seen some decline in average price per unit, price per square foot. Part of that is more the sales have been suburban, but cap rates have held, and we'll get to that in a moment. Now, getting to the cap rates, we're looking here. Here's a curve showing back from 2001 to 2020. Top line is US. So cap rates started after the recession about 7%, got down to the low fives. Here in Puget Sound, we started about 6.5%. Now we're in the mid fours. We've seen a touch of a tick up with a couple of transactions in the last few months. But again, this baseline is about a 6.5% cap rate. So we still remain a market that's outperforming the rest of the region in low cap rates. We have not seen that much change in cap rates. Turning to velocity and pricing, this is data from the first half of the year. The graph on the left represents Q1 and Q2 of 2019. Not surprising, the graph on the right, 2020, Q1 and Q2. Now, what we're seeing is huge amount of sales volume in the number of deals. That's what's in gold, the circles, and the bars are transaction volume. There's been a huge drop off, no question there. Now, interestingly, if we look at the actual sales trends on price per square foot, that's the bars, and cap rate is the gold circles. 2019 to 2020, not that much different. Small decline in price per square foot, small decline in cap rate or expansion in cap rate, but really not that much different. So overall pricing has not changed that much, but we'll talk about in a minute of what's driving a change in pricing. Some predictions of what we expect to see in the market. This is CoStar data. I wanted to include it because I wanted to be consistent with their rent and vacancy trends. They're predicting we're going to see a spike in cap rates. The orange line is CBD, followed by urban, followed by the green is suburban. I don't expect to see that much expansion in cap rates. Cheap money is not going away, and there's a lot of demand to own assets. We'll get to that in a moment, but there is a prediction we're going to see a spike in cap rates. We'll see if that tends to be true. That looks like it's going to play out by summer of next year. We're going to ramp up to that, and then it's going to subside down again. So we'll see how that plays out. I think cap rates are going to remain low. Couple of key takeaways for sales trends. One, it's all about NOI. Expect cap rates to remain steady, but NOI is decreasing. We're seeing in rental rates, we're seeing in vacancy, concessions, as well as collection loss. So really, as you're trying to understand the value of your building, it really is all about NOI. Pay attention to cap rates, but we're not going to see much change. Buyers are just underwriting NOI differently. Sales market slowing. We've seen a bid-ask spread from what buyers are willing to pay and what sellers are asking, far fewer sales. Interestingly, in the last week or two, we've seen a little bit of a change. Right now, we have 25 transactions either on the market or under contract, and we're seeing a lot in the marketplace with those 25 different deals. We are also underwriting to take to market about another 20 transactions, and we're getting a sense of what sellers' expectations are and what buyers are willing to pay. So we're starting to see that bid-ask spread narrow a bit, but what's been happening has been too wide to really create transaction volume. Next, interest rates impacting pricing. In a good way, cheap money means sales still happening. So we're seeing debt anywhere from the low twos. I've got a client that had fixed year debt, 10 years interest only at 2.22. That's somewhat of an anomaly. I'd say most groups are underwriting debt somewhere between 2.5% and 3.5%. So at cap rates at 4.5%, a lot of deals still make sense. Finally, sales will pick up. Even if we're in a recession and we stay in a market that's uncertain, is capital needs to find a home. Capital has taken a little bit of a vacation in 2020, trying to assess what's going to happen. I expect sales are going to pick up. Will they pick up to the extent of what we saw in 2019? Absolutely not. But as buyers get a little bit more comfortable, sellers get a little bit more understanding of what's happening in the marketplace, we're going to see transactions continue to happen. Next, a quick look at employment. I want to show some good news. Pre-COVID, we had about 6,000 initial claims for unemployment in Washington State. Here we are through COVID, through May, they spiked about 120,000. And here we're coming into data year to date. This takes us to the first week of October, about 20,000 claims. It's 3x of what we're used to, far down from where we are. What's really telling is actual unemployment. The top line of each of these was April, and we can see in each of these markets versus August, about half. So we had about 15% unemployment in King County in April. It's down to low sevens. My expectation is in the next 6 months, it's back in the fives. So across each market, it's pretty clear we had a big spike. It's now coming back down. King County will lead the march on this, but really we're starting to settle back down. And I think we're going to get back to business as normal, maybe from home for most of 2021, but we are getting back to more business as usual. What's really telling is the actual advertisements for jobs. So this is the 25 occupations advertised in the region in August. Number one, still software developers and applications. Average wages, $137,000 a year. Absolutely terrific. We look at managerial jobs, $125,000. We look at computer occupations and all others, still six-figure jobs. These are the top occupations being advertised. There is still absolutely strong demand throughout the region. We're seeing it across the region with employers. Here's a prediction of when we get back to full employment. The gray bar in the center is where we are right now. You look from 2009, you see that blip that happened from 7 to 9. We've marched up and we're coming across. We dipped back down and here we are. We're predicting this is going to bottom out and we're going to have a V. Now, unemployment was predicted to be in June, 2.1%. Now the new prediction is 2.4. Economists tend to lag these things. I bet we're getting back to 3% employment growth as we get into 2022. And what we were seeing the last several years was between 2.5% to 3%. We're going to be back marching up to previous levels. So it should provide a lot of faith that after we get through this 18, 24-month period, we're going to see a lot of vibrancy. Next, looking at a forecast. Here's the graph we looked at for a number of years. This expansion cycle was 128 months. Normally they average 65 months. So we doubled that amount, nearly doubled it. So we are in a recession right now. The question is, how long will it last? What I've done is I've measured some recessionary periods. Let me get to this first. First, where to focus is we're in this recession, what we're doing right now. Balancing rental rates versus occupancy. That's the thing that we've talked about. It's important for all owners to figure out what is that equilibrium point between raising rental rates, maintaining occupancy, or even allowing rental rates to drop a little bit just to keep your building full right now. Next is riskier assets, new construction, tougher to lease up right now. they're not that risky. It's just riskier on the spectrum in highly leveraged assets. We did not see a lot of leveraged assets. I think the challenging thing we're seeing in the market is those on bridge debt that are trying to renew bridge debt. It's very hard to get bridge debt right now. And financing is fantastic as long as you have a full building and people paying rent. But if you're not in that narrow category, financing is tough. So if you're highly leveraged or new construction, those tend to be a little bit riskier. The next 12 months, pay closer attention. Next thing to focus, expenses. Operational costs continue to go up. We all see it with more legislation, more oversight, and tax assessments are remarkably high. We just valued a property the other day. We're coming in a value around 10.5 to 11 million. The assessment is over $14 million. So it's coming to a time where assessors have trailed the market. Now assessors are leading the market, and it's coming at a time where actual collections are lower, but expenses are higher. So it's something that we're all going to have to watch. Next is some reversing trends. We've talked about urban to suburban. We're talking about wanting indoor amenities and highly amenitized buildings to go into more outdoor markets, and people being in studios versus 2 bedrooms. There wasn't a lot of demand for 2 bedrooms early in COVID. People wanted to be by themselves. Now they're starting to double up to save some money. So there's some reversing trends. Some are going to stick, some will not, but there's some areas to focus on what some long-term strategies will be. Finally, legislation, lots of headwinds. I encourage all of you, get involved in local politics. We need to help our industry. Our industry is underrepresented when it comes to legislation. If you want to know how, please contact me. Our team, along with many of our clients, are getting more involved in legislation. We don't have time for it today, but it's an absolute area we all need to focus. Where are we headed from here? I did some forecasting and looked at the Bay Area and looked at the 90s cycle. From trough to peak took about 8 years. Next cycle from trough to previous peak took about 4 years. Next cycle from trough to previous peak took about 2 years. So we're seeing in these coastal cities that are shipping software globally, these down cycles are much shorter. When you're in the middle of it, it's hard to see the end of it. But for a lot of people that are really focused on long-term ownership, which we're all focused on at least 3 to 5 years of ownership of these assets and developments, we're going to be out of this before we know it. It's time to focus on where we want to make these bets when there's greater opportunities in the market right now. Some of the reasons I'm seeing this phenomenon: global shipment of software, technology ecosystems, concentration of workforces. We're still seeing that in this region, although we're having some challenges right now. These are phenomenon that are continuing to drive this region forward. Next, when are we going to recover? And what are the economists saying? So I want to get a little data of truly what the economists are predicting. And what they're predicting is Q2 of 2022. So 2 years just passed us in the window of last quarter. So they're expecting we're going to be in this until mid-2022 till GDP picks back up. It's hard to predict that. Economists oftentimes lag the market, so it's pretty easy for me to armchair it, but I expect we're going to see some grass shoots as we get into 2022. And when we're through 2022, I think the broader market's going to see that. Here's just a quick historic look at rent and vacancy that I thought was interesting. Looking at, this was some market research we did in 2018. And what we see here in yellow, this graph in yellow is vacancy rates. What you see in green is, or actually blue, is rental rates. So we saw a spike in vacancy, a flattening in rental rates. Took a while to get out of that recession. Moving forward into the Great Recession, spike's not as high. We didn't have nearly as much vacancy. And then we start to see rental rate growth picked up quite a bit. So I think that's a good precursor of what we're going to see in our urban markets again. We do have more development to get through this cycle, and that's why we have to analyze each one of these submarkets a little bit more granularly. Yet I see very positive signs this region and its urbanism still has a lot of legs, especially compared to our cohort markets in San Francisco, New York, LA. So long-term forecast, some key takeaways. Seattle will be one of the first markets to see economic vibrancy. I have no question about that. It's a strong market. Next, Global health, science, and technology sectors will lead our recovery. Everyone will agree that we're recovered by 2024. But what's important as real estate investors, especially as these are long-term investments, is to get in earlier and ride that wave up. And my expectation is that recovery is going to take hold by mid-2022, early 2023, which means you're making bets in 2021 to get capital to work and get into your asset to ride that wave up. So I know it's pretty easy to say jump in, but really the opportunities in these markets are pretty tight. And I really see that we're going to see a recovery much sooner than most people feel. And generally that's what happens. Generally we see the spikes in the market, the peaks in the market after they're behind us, and we see the recoveries after they're behind us. Finally, it's going to be a bumpy ride. Hang on. I think there's a lot of positive things out there. People tend to thrive on negativity right now. The bumpiness allows us to be negative, but there's a lot to be thankful in this market. Just accept it's going to be a bit of a bumpy ride, but we will remain one of the best markets in the region. We have the dynamics that are going to carry us forward. So we feel very positively about the market. Finally, one last note. Today is my birthday, and I wouldn't normally do this, but I'm going to ask each one of you guys for a gift today. And I've never done this before, but I have spent the month of October doing fundraising for Bellwether Housing. And we have set a goal as a team to raise $25,000 for Bellwether. Bellwether is a nonprofit we're very involved in, we feel passionately about. I assume if you're on this phone call today, you make a living on market rate for rent housing. And our ask today is that you help us out. I know we have a lot of clients on this call that have helped us get to nearly $19,000 as of this morning. My ask today is if you're on this call and you can donate any amount, help us out and hit our goal. You have to, the URL is a little finicky, so it's www.dylansimon.com/bellwether/ that's a tough one. If you just have to Google Bellwether, it's called the Closer to Home event. And then you get to that page, and then you click on the event page, and then you find the virtual table page for us. I know that's a bit complicated. If you just want to email me, I'll respond to your email. But my birthday wish is to hit $25,000. And if we can just get some engagement on this call, even if it's just $50 or $100, whatever you're comfortable and able, if you can give more, that's terrific. But it's my birthday wish to hit this goal this year, and I am hopeful you can help me get there. Finally, want to thank our entire team, my partner, Jared, my partner, Alex, Matt, Brandon, and Winslow. We're all grinding away in here. Like I said, we're very active right now representing apartment owners and sales. We're representing a lot of buyers and off-market transactions, as well as developers and land. We're very busy right now. It's been a topsy-turvy year, but we're really engaged. I want to thank each one of them for making this possible. I get to be in front of you guys, but the only reason I can be is they're all hard at work making this possible. So I want to thank each one of them. It looks like I'm over time by about 5 minutes, but want to thank everyone for joining this call. You can find a lot of our research on our website, and wishing you guys a wonderful holiday season and looking forward to staying in touch with everybody. And thank you so much.